Hi. Uh, Let us go and start with the butterfly spreads now. Now coming to the long butterfly spread. See all butterfly spreads are neutral strategy. You should understand that there will be limited profit and limited loss. Okay. Now, how is it created? A butterfly spread is created with three different strike prices. Okay, where K1 is in the money, K2 is generally at the money, and K3 is out of the money. You should know what is in the money, at the money, and out of the money. If you don't know, please go back to my video which I have made for the introduction of options. You will find all these details there. Now, here a long call with strike price K1, which is in the money, is bought. And two calls were sold at the money strike price of K2. And one call is bought at far out of the money K3. And you must be aware that K1 and K3 are at equal distance from the at the money call of K2. See, this strategy will result in a net debit spread. Net debit. You have to pay upfront to execute this strategy. Let us see how this strategy looks like. First, let us take the two short calls. See, there is a two short call which has been made, and what does it do? Till the time the price strike price is below K2, you will keep the premium, but once it goes beyond K2, there will be unlimited loss. Okay. Now, there is one long call. What does the long call do? I have already explained. Till the time it is at K1, you will just lose the premium. But once it goes beyond K2, you start getting into profit. And finally, another long call at K3. Okay. Now here, till the time the strike price is below K3, this long call will give you nothing, and you will lose the premium which you have paid for it. Okay. Now let us see the table of the payout. Suppose if the strike price at the end of the expiration S strike price at the end of expiration time T is less than K1. This is the K1, right? It is less than K1. What happens? Your both the long call will yield not yield any money, any payout. So long call K1 will be 0 and long call K3 will be 0. Similarly, short call will not result in any loss because the value of the strike price is below K2. Hence, you will be very comfortable keeping the premium, the difference in premium of two short and minus two long calls. So this is the net premium which you are going to pay, because short call at the money is always very costly, which you are going to sell, and two long calls will be there. So you are going to pay a net premium of about the difference in the premiums here. Now let us come to the next situation. In this situation, if the strike price is between K1 and K2, what happens? Your long call will be in profit because the price has gone beyond K1, and you will lose the premium with the long call 3 because the price is not gone beyond K3. At the same time, you get to keep the premium here of the two short calls because the price is not gone beyond K2, hence there is no loss. So hence you make some amount of profit here. That profit will be equal to ST minus K1. Now let us assume the price comes here between K2 and K3. When the price is between K2 and K3, you will earn some premium increase happens in the long call K1, as a result of which you will have a positive side, that is ST minus K1. Here ST minus K1. However, the long call of K3 will not yield any result, hence it will be 0. But K2 will start getting into loss because the value has gone beyond K2. So, two short calls will start getting into loss. Hence, the total payoff will be K3 minus ST. It will be a mild profit. Now, when the value of the strike price goes beyond K3 here, okay, what happens? As such, ST minus K1 will remain because long call will be in the profit. Your long call at K3 will also be in profit, and your two short calls simultaneously will be at the loss. Hence, what is going to happen? This is going to be the loss. Net premium paid will be the max loss. We'll see how it works out here. See, this is what happens. So, when the strike price is between K1 and K3, or we can say when the strike price is near to K2, that is at the time of expiration, you will get a little amount of profit as can be shown. However, as soon as it starts going beyond these points, you start losing money. See, but the loss will be limited. There will not be too much of loss. So this has got a limited loss and limited profit. Okay. Now let us go to the next one. Here what we are doing, instead of long call butterfly spread, it is a short call butterfly spread. What does it mean? It is again a neutral strategy, but short call butterfly spread, since we are shorting, there will be net credit here. Same position, K1 in the money, K2 out of the money, and K1 in the money, K2 at the money, and K3 out of the money. So what here we are going to do is, there is going to be a short call with strike K1 which will be sold, and you are going to buy two long call at K2, that is at the money, and you are going to short call at K3, that is the far out of the money. And as usual, K1 and K3 are equal distance from K2. Now let us see how it looks like here. So at K2 you have purchased two long calls. Okay. As soon as the price start moving beyond K2, you will the two long calls will start earning profit. Here it is short call, so you have shorted at strike price 3. Okay. Till the time price does not move beyond K3, you will not get into any losses. So till K3, with this short call, you are safe. Now here at K1, if the strike price is below K1, then there will be no loss in the short call. You will get to keep the premium. Okay. Otherwise, if the stock price start moving beyond K1, then this short call will lead to losses. Okay. Now this is what is going to happen. So there will be limited profit if the price moves drastically below K1 or above K3. However, if the price remains within very near to K2, then you will have a limited loss. Let us see it through the table here. So if the value of the strike price is below K1, what will happen below K1? See, this short call, it will not yield any loss because you will get to keep the premium. So you will this one result in profit, because anything below K1 you will get to keep the premium and there will be no loss. But since the value is below K2, these two long calls will result in zero output. Two long calls will result in zero output, because you get to the premium will be you will lose the premium which you have paid to establish this strategy. And finally, your short call here also you get to keep the premium. There is no loss. So there will be no loss from the short call at the strike price K1. There will not be any loss from the short call at the strike price K3, and there won't be any profit from the long call at K2. Two long calls at, this is not K1, this is K2. This is wrongly written here as K1. Please correct it as K2. K2 is here. Okay. So what happens, since it is a net credit spread, okay, what is going to happen if it is less than S2, you will result in a premium collection. Whatever the minimum premium you have collected, that is the net premium, that is going to be your profit. However, if the value strike price at the end of the expiration is between K1 and K2, what is going to happen? Your long call will still result, it will not give you any profit, and you lose the premium from these two long call. The short call at K3 will not lead to any loss, and you will get to keep the premium. However, since the value is between K1 and K2, this short call is start resulting in the loss. What will be the loss? The loss will be K1 minus ST. So you will have a max loss of K1 minus ST if the value of the strike price at the end of expiration is between K1 and K2. Now let us assume the next situation when the strike price is between K2 and K3. What will happen? If it is between K2 and K3, the short call at K3 will not result in loss, and you get to keep the premium. You have collected the premium here, no? You will, you can keep that premium. However, the two long call will result in profit, because we have moved out of K2 and you have come here. So this one will result in some amount of profit after when you move beyond K2, because long call will result in a profit. However, short call will result in a loss K1 minus ST. So the total loss will be ST minus K3. Okay. Now finally, when the price moves beyond K3, what will happen? This two long call will be extremely deep in the money. Hence, since the premium moves exponentially, these two long will be in the profit. However, at the same time, this short call, since it is here and the prices already moved beyond K3, this short call will be in loss, and this short call will also be in loss. As a result, what will happen? Your profit here gets compensated by these two losses. However, since there is a net credit you have already collected in terms of the premium, you get to keep the premium. So the maximum profit will be the net premium collected in both the cases, when the price is beyond K3 or when the price is below K1. Okay. Okay, now let's go to the next. Now we discussed long call butterfly. Let us discuss long put butterfly. The result will come the same. We are only using put instead of the call. It is again a neutral strategy. It will result in a net debit. Similarly, in long call butterfly spread also, it resulted in a net debit, isn't it? So the condition will remain the same. K1 is in the money, K2 is at the money, and K3 is out of the money. Instead of buying a long call, you buy a long put at strike K1, and you short two puts at K2, and you buy one long put at K3, where K1 and K3 are at equal distance from K2. Now let us see the payoff diagram. See, this is the first instance, that is a long put with strike K1. So at strike K1, you have purchased a put. Any price movement below K1 will result in profit for this particular strategy of naked long put. Now you have two shorts put. Short put is actually bullish. It means to say that if the price remains above K2, you will keep the premium. However, if the price starts moving below K2, what will happen? You start incurring loss in the two short puts. Finally, there is a long put at strike price K3. So if the price moves below K3, what will happen? You will end in profit. However, if the price moves beyond K3, what will happen? You will lose the premium. You will not, but there will not be any further loss. due to price movement. So let us analyze this. Here what will happen? If there is a very drastic price movement, you will have limited loss. Whereas if there is very little movement, or if the price stays close to K2, you will earn maximum profit. Okay? So let us analyze this. So if the strike price goes below K1, what will happen? Since it is going below K1, your K3 long put will be in the money and K1 long put will be in the money. Okay, both of them. However, these two short put will be, in loss. As a result, you will the two short puts will get compensated for the profit you earn in two long puts. As a result, you will get into a loss. What will be the loss? The loss is nothing but equal to the premium which you have paid. That is all. Now let us assume the value lies between K1 and K2. What happens? The long put K3, this one will be in profit, because, and it is equal to what? ST minus K3, this one. At the same time, since it is between K1 and K2 and the price has moved below K2, then these two short puts will also be in loss. As a result, you will have minus of 2 into ST minus K2 in the loss. What will happen? The total profit, because this will be in profit and there will be two short call. However, you have paid some premium. So K1 minus ST will be the net profit which you have earned. That's what this diagram is trying to tell you. If the price stays close to K2, you will get into profit. That profit is because of the long put here, that is K3 to this, and since it is very near to this, you may not, the price may not have moved much in the short put, and hence this will result in a mild profit in the at the time of the expiration. Similarly, if the price is between K2 and K3, what will happen? The long put K3 will still be in profit. Okay, the long put K1 will, you lose the premium. However, you get to keep the premium of two short puts, and there will be no loss generated because of these two short put, because the price is above K2. As a result, you make some profit of ST minus K3 equal to the long put profit, isn't it? Now, if the price goes beyond K3, what will happen? You lose money from long put, because you will lose the premium here and you lose the premium here, but you get to keep the premium of these two short puts. That is the net debit which you, at the start of the execution of the strategy, you have shelled down some money. Yeah, that money is debit. So that is the maximum loss which you are going to incur. See, please, if you want to understand this concept, you have to listen to this video again and again and again and understand the concept. It is just not possible to assimilate this concept just by seeing it in one go. Trust. Okay, now let us continue with the next strategy, that is the short put butterfly spread. Here also, the condition will remain the same. That is, K1 is in the money, K2 is at the money, and K3 is out of the money. All right. Now, there will be a short call which strike K1. Then there will be two long calls at K2, and there will be one short call at strike price K3. So this is again a neutral strategy, and K1 and K3 are at equal distance. But this strategy will result in a net credit. So how will you get net credit? We will discuss that. Because you have shorted in the money. So since you have shorted a put deep in the money, the premium will be high. So you're collecting a higher premium. Similarly, this short put is, here will also result in collecting of the premium. isn't it? Now, this is at the money. At the money, you are buying two long puts. Okay. Now, let us see what are all the situation which you have. First is if the strike price ST is less than K1, K1 से अगर कम है तो क्या होगा? What will happen? This two long put K2 will be in the money. Okay, 2 times long put will be in the money. However, both the short puts will be in loss. As a result, you will result in net profit. How net profit? I will tell you. Since the two long put is taken at the money, the delta of two long puts will be usually higher than the delta of out of the money puts. So what will happen? As soon as the price starts going below the K1, the two long puts will start moving exponentially higher. As a result of this, what will happen? It gets compensated by two short puts here, one, and another short put here, two. So both of this will get cancelled out, and the only money you are left with is the net credit which you have collected at the start of the execution of the strategy. So if we go through this, payoff from short put K1, this is the payoff from short put K1 will be in loss, that is K1 minus ST, and payoff from short put K3, again it will be in loss, that is K3 minus ST, and two long put will be in profit, that is 2 into ST minus K2. So the total payoff from this entire strategy will be 0, but you have collected some premium initially that is going to stay with you. Now, coming to the point where the strike price lies between K1 and K2. So if it lies between K1 and K2, what is going to happen? Your two long puts will be in the money, matlab that is in profit. Your one short put at K3 will be in loss, and this short put K1 here will not be in loss. So if we go to that, payoff from short put K1, this is the payoff from short put K1 is 0. Okay, it is, you have premium collected, no? So the price has not moved below K1. Hence, it is that premium collected is still remaining with you. Payoff from short put K3, this it will be in loss, that is equal to ST minus K3, because you have moved out of its comfort zone of K3. Hence, it will be in loss, that is equal to ST minus K3. However, two long puts will be in profit, which is 2 into ST minus K2. So the total loss that is going to be is ST minus K1, which will be the loss for this particular strategy. Now, let us come to the next part, that is if the value lies between K2 and K3. So if lies between K2 and K3, you lose the premium of this long put, and you keep the premium of one short put of at K1, whereas one short put at K3 will be at loss. So the loss will be K3 minus ST. So this K3 minus ST is going to be the max loss. Now if the price goes beyond K3, what's going to happen? Your short put is not at loss because you have already collected the premium. Here the short put at K3 you have collected the premium. Your two long put at the money you have paid the premium, but you have collected a net amount of at the start of the strategy. That is going to be your profit. That is the premium collected. Net premium collected will be the profit. So this is short put butterfly spread. Yeah, with this we come to the end of the discussion on butterfly spreads. In the next video, we will discuss straddles, strangles, strips and straps.